Okay, cool. Hi, I'm Caitlin. So I'm just going to have everyone go down and introduce themselves as we get started. And I think there is the audience questions that you guys can submit, so we hope to get some of those at the end. So feel free to submit questions and things you guys want to discuss. Aya, you want to start?
Great, thank you so much. My name is Aya. I am the head of institutional coverage at FalconX. I lead all of our sales trading desks as well as anything client-facing for the firm. FalconX, we are helping some of the largest financial institutions access digital assets through trading, clearing, and credit.
Hi guys, my name's Ed Carlton. I head up the institutional digital asset desk at Flow Traders. Flow Traders, for those that don't know, is a technology-driven liquidity provider with a long-standing pedigree in the ETP space, but obviously relevant today, a leader in the digital asset space too.
I'm Jakob. I'm the CEO of GSR. GSR is a market maker in the crypto space. We also do asset management and venture investing.
Hi everybody. My name is Markus Infanger. I run institutional markets for Ripple. Ripple is a blockchain crypto solution provider based in San Francisco. Pleasure to be here.
Hi everyone, my name is Igneus Terrenus. I'm the head of communications at Bybit. Bybit is the world's third most visited crypto exchange. We also have one of the best liquidity in the market, especially for Bitcoin and ETH. Usually you see like 20% of the entire market's liquidity happening on Bybit, and the least amount of slippage as well. Very happy to be here with this delightful panel.
Cool. So I'm going to get started. I'm going to start with Jakob, but guys, feel free to chime in as you want to and add other points. But Jakob, I guess, how does market making in the crypto space differ from that of traditional finance?
Yeah, I think there's some uniqueness with crypto, which makes liquidity uniquely important. So if you have when you're trading a token, it has a number of properties that actually make the network function. And without that liquidity, the network doesn't function. That's not really the case in capital markets. If you're driving your Tesla, it doesn't stop because liquidity drains from the Tesla share price. Nothing happens, you keep driving your Tesla. But if Ethereum doesn't have liquidity, you can't process your transactions, you can't validate the network. So that means that being a market maker in this space, you can do market making as a service. And it becomes increasingly important as you're taking your disruptive technology to the market and trying to scale it. And that's why people like us and other people have been able to build very big client franchises as market makers, as opposed to being, buying order flow and trading hostile or toxic against the market.
Cool. And I guess, what is the state of crypto liquidity at the moment? Are we having liquid crypto markets? Are they as traditional, as liquid as traditional financial markets?
Yeah, so even taking a step back, what did the markets used to look like and where are we today relative to that? So, roughly 4 or 5 years ago, a lot of crypto liquidity was retail driven. And so you started by having local exchanges around the world that popped up as the central hub for retail to get access to crypto. So you would see Bitso in Mexico, Bitstamp here in Europe, Coinbase, Kraken in the US. And then primarily as institutions started to get interest in crypto, you had this demand for OTC desks, over-the-counter desks, or market makers, as you see the folks on the stage today. And what you started to see was this fragmentation between those that wanted very large order sizes, so anything over, let's say, 1 or 2 Bitcoin, and those that wanted smaller order sizes, so more retail-facing platforms relative to institutional-facing platforms. So you have a number of different liquidity providers today. It'll be anywhere between lit pools like exchanges and then dark pools like the OTC desks, as well as a lot of venture funds, miners, all of these folks who have really large balance sheets, protocols, treasuries that want to exchange their crypto but don't want to do it on an order book today because it'll have an impact on price. One great example of that is if you look at Luna and their recent $3 billion BTC purchase. A lot of that may touch retail exchanges, but a number of that will actually stay in dark pools where they'll find liquidity for that with motivated sellers. And so I think the space is still incredibly fragmented. One of the things, even as another example, during Black Thursday, when the market crashed a year ago, there was actually no liquidity on order books. No one wanted to buy Bitcoin. And so people were motivated to sell, sell, sell. You saw a flash crash of liquidations because there weren't buyers on the other side. And so you're still seeing that today. And the reason for that, what's really interesting, is that in comparison to traditional markets, when you do have a flash crash, the exchanges turn off. And so you see order books turn off, and then S&P, NASDAQ, they turn off, and they will just match the orders on the back end and make sure that books are all aligned before turning it back on. Black Thursday actually happened. Bitcoin was almost saved because a consortium of exchanges turned off in Asia, which was able to help regain liquidity on these exchanges. But in general, that doesn't happen in crypto. So you see a little bit of changes, but we're still not as liquid as traditional markets, and it's still fragmented, but we're definitely getting there.
That's good.
Can I just chime in here quickly?
Yeah,
so
please.
in terms of describing the state, I feel something really key happened in this last adoption spur 2020, in the sense that, crypto, in terms of just the market size overall and also volumes, have reached critical economic mass in the eyes of even the largest financial institutions. Before, it was predominantly retail driven, and now things like, Bitcoin achieving 10% of the market cap of the whole gold market, or a company like Coinbase with 1,500 people generating revenue commission income the size of traditional investment bank with 40, 50,000 people. Has just really opened up the eyes. So it's fair to say, in the eyes of traditional large institutional players, this place has become too big to ignore. No, it's not a fad. It's not going to go away anymore. And so all of them are looking for an entry now. And also regulators, which are obviously key stakeholders for the whole adoption to thrive. They can no longer ignore it. So as these two dynamics now are playing out, that will just underpin so much more liquidity growth from here, as I see it.
I mean, on some of the lack of liquidity that we still have, I guess within the landscape, how do you figure out where are the good liquidity providers to get it in times of a sell-off? And how do you figure out, whether there even needs to be kind of that parallel to traditional finance of, shutting down exchanges when prices get too volatile? Because I know kind of the crypto ethos has long been, completely open trading. Bitcoin trades 24/7. People who trade stocks get to take a break on the weekends and stop looking at their phones, but that's not the ethos of crypto. I guess, how do you go about figuring out, who are the liquidity providers in times of crisis for you guys also, and how much it needs to mirror TriFi and some of the curtailments?
Yeah, I think to pick up on that one, you're looking at who are the liquidity providers. Often people say, well, it's the exchanges, right? Well, yes and no. They are definitely the mechanism to access the liquidity, but who's behind that? And looking into that, it's still arguably largely retail-based flow on one hand, but then there is institutional participation from the likes of market makers, etc., putting up institutional liquidity. And the role of the market maker, contrary to popular belief, is not just about making money in a profitable business, but it's about price discovery, creating a clear and transparent and fair market. And this is definitely something that resonates with flow traders, and that we try and emulate from what we know in traditional markets over into the crypto markets. So to address back to the question, we've got this element of, okay, where is the actual liquidity coming from? I think then you also need to look at elements like, you're mentioning circuit breakers. So operationally, what can we put in place to help create an environment to allow this liquidity to thrive? We mentioned from a kind of, not even regulation, but I guess operational standpoint, having mechanisms in place like circuit breakers, which will kick in if markets move. But also operationally, when you're looking at these exchanges, I think you do have to be somewhat cognizant of the fact that many of them have been around for less than a decade, which does, to a degree, have some operational risk. Are the people who are running these exchanges familiar with very high frequency markets, very high transactional markets? and running the technology in order to support it, because it is, it's not an easy feat. I think much less so now, but definitely in the early days, exchange outages, not an agreed upon consortium, but like by kind of something going wrong, you would have exchange outages, and that's, that obviously is very problematic. So I think addressing, operational risk, regulatory or kind of framework risk, and then having organic liquidity is really key. So maybe from those three pillars really do contribute to providing kind of true liquidity in that sense.
To build on that, initially, I remember in our early days, a lot of the work that we did was clean data from exchanges. So different exchanges had different timestamps, which was absolutely nuts to try to figure out what the price was at any given point or time. Most exchanges only had REST APIs, if they had APIs at all. Now they all have fixed APIs. And so a lot of that standardization, to your point exactly, a number of exchanges also used to have futures or perps derived in crypto, which created very, very volatile markets if the underlying token moved as well. Now most of them are derived in stable coins, which is why you've seen just the stablecoin market itself over 300% growth from last year. And so I think you're continuing to see that level of standardization, and I think we'll talk about that a little bit more as well. But to the earlier point, a lot of that is because we're servicing 50 billion plus asset managers who require that level of standardization and support, and 24/7 support and coverage nonstop. And 24/7 support is really expensive. You need to have people working weekends. You need to have people who are constantly checking books. When you think about even in traditional financial markets, when they make you take 2 weeks of vacation so they can check through your books, you don't have that in crypto. And you don't have weekends and holidays as well too. So all of that leads to the expense, but you have to do it for the type of institutions entering.
So it sounds like most people on this panel, sorry, Markus, did you want to make a point?
No, just quickly to chime into this question about where liquidity comes from, I would love to talk a little bit about this from the lens of sort of use cases. And I think everybody would agree most of the crypto liquidity right now serves sort of the use case of speculation, fueled by incentives and so forth. And not denouncing that, I think it empowers the industry to really innovate. However, I think as as crypto matures and lives up to its full potential, I think this notion of real world utility will become increasingly more relevant. And just to give you an example, so we at Ripple, with our flagship product, on-demand liquidity, we're literally harnessing billions of dollars of XRP liquidity to facilitate cross-border payments in a couple of seconds from, say, the US to Mexico instead of your 2-3 days like in legacy systems. So really solving a massive pain point in this world, which is how money moves around the world. And these are use cases that can scale in the trillions. So I think the future of crypto liquidity will be shifting more towards solving real world problems as opposed to just speculation.
Igneus, go ahead.
I think I agree with a lot of what Mark said, but I also want to challenge one point is that sort of like liquidity, utility is not here. I think, for people who live in mature economies where, you feel kind of like everything is relatively stable, you can afford to talk about crypto as if it's a speculative bet. But for people living in Turkey or Argentina where, the inflation rate is 50%, Bitcoin is not volatile. Even if Bitcoin loses 40% of its value, when you denominate it in lira, it's still going up. So, I agree with definitely the cross-border payment and in places like El Salvador that up to 30% of their GDP is actually lost in cross-border payment because there are so many just like El Salvadoran diaspora working in other places and they need to send that money back, and Ripple is definitely having a use case there. But at the same time, for people who are living in double-digit employment rate combined with double-digit inflation rate, and many of them don't actually have access to bond market, don't have access to US stock market. Many of them don't even have access to US dollars. So crypto is serving a real need there where it's the only liquid asset that you can trade globally. liquidity, like, of course, it's scattered, but at the same time, crypto has this ability to move funds much more quickly than the traditional banking systems plumbing in T+2 days, whereas crypto, like average block size of Ethereum is 13 seconds. It just moves the money a lot quicker, and then between exchanges, between different kind of service providers, it's much easier to go back and forth rather than like instead of if you try to buy like some futures of some commodity, you need to move through all those different layers, all those different institutions with all their internal checks and due diligence. Crypto actually allows liquidity to flow at a much more rapid and much more reliable and much more succinct way.
Igneus, I think one of the points that you had made when we were doing prep for this panel was that liquidity in DeFi isn't quite the same as that in CeFi. And I know most people on this panel are more focused on asset managers, traditional finance. I'd be curious kind of your thoughts on what is the state of liquidity in DeFi. And Markus, if you want to jump in, please do.
Yeah, so I think, look, it's obviously had massive momentum, right? At the same time, I think the big showstopper or bottleneck is compliance, AML, KYC, right? And I think there's a solution on the horizon that will help to solve that, like compliance, intelligence, and all that stuff. And once that solves, I see a massive amount of growth on the DEXs happening, and that's essentially the bottleneck I see there. But I think institutions will start to allocate. They start a little bit into this whole DeFi economy, and over time, I see literally DEXs, like for example, the XRP Ledger, that's actually the oldest DEX on a public blockchain. I see a decentralized exchange like this really powering enterprise use cases, even like on-demand liquidity, where we use regulated exchanges right now to facilitate cross-border payments.
One thing I find quite interesting and I want to kind of address is that there always seems to be kind of a polarization between centralized and decentralized, and it's like you can either only talk about one or the other, which I don't, it's kind of, you don't have a choice. It's like that or that. You can't have both, which I really disagree with. My view is, look, you've got two horses running in this race. Let's call one the centralized horse and one the decentralized horse. And for the centralized horse, this may lend itself more for some of the traditional financial market players who will only be able to get involved in capital markets where it emulates the capital market structures that they're used to. It's a lot of it actually comes down to simple facts that humans are relatively simple. We don't like change, so let's try and emulate, financial market systems, whether it's pre or post-trade structures that we're used to, and that path of least resistance is what's going to allow the capital inflows from legacy markets into this newer asset class. That doesn't mean to say that that's at the expense of the decentralized horse. He can still run off into the future with some people saying, look, actually, that's a bit slow-paced for me. We want a bit more revolution than evolution. And let's get stuck in something that, no, we don't need to speak about centralized clearing and TCPs because actually that's what the smart contract does. And we're going to put our faith and our trust in code, right? So I just think it's something that often in these discussions, it's asked, one or the other.
Yeah.
Both horses can live side by side. It's just that they're running their own race.
I mean, if you look at the decentralized versus centralized liquidity today, price discovery is an order of magnitude worse on decentralized decentralized exchanges because they are slower. They work usually with a sort of a bonding curve and having permanent loss versus you have the central limit order book. The other part is that you need to verify those transactions over the blockchains versus if you trade with a centralized exchange is momentarily. You also have capital inefficiencies in crypto in general. So I would call even centralized exchanges being quite capital inefficient. You need to put capital on the exchange to trade, which is rare in traded finance. But in decentralized finance, you actually need to put up both sides quite wide. There are V3s, and we're seeing improvement. At some point, these things are going to, the decentralized exchange is going to be better and faster, and price discovery is going to improve. That's just the normal trajectory. But today, obviously, if you're agnostic versus if price is discovered on-chain or off-chain, there's a huge amount of trading opportunities. And I think even for networks that are trading, you don't necessarily want your token, if you're a token issuer, to have vastly different prices across all these different dual listings that you're having, that doesn't really foster participation in the network. It just fosters quite a lot of sort of manipulative type trading opportunities. So eroding those and making the market more efficient is probably where we're going to see this the path going.
To that point as well, today, one of the things that protocols, if you look from the protocol perspective, they use DEXs as a way to go to market in a much cheaper manner. So today, if you want to go to market on exchanges, it costs $200,000 for listing, and then you have to partner with a market maker, which has a cost to it associated as well. Now, you will get a more institutionalized product and process out of that, and you will target a much more institutionalized base. But for a lot of protocols who don't have that kind of capital and haven't raised that kind of round initially, but want to go to market, they can launch on these DEXs directly with liquidity on both sides, and then garner interest through Twitter or other community measures. And so you've seen actually a lot of that work for certain providers, and then for other providers, you've seen that completely fail, which is just the power of having a market maker to start. But it really depends on who's the persona that the protocol is looking to face at the end of the day. And relative to that, if you are looking for overall growth, your protocol will only gain X amount of traction until it just needs that institutional capital and exposure in order to grow much larger. So what you've seen is a lot of that initial price discovery will start potentially on DEXs, but it will inherently move to Coinbase or in the US or other exchanges, Binance, Huobi, OKX, et cetera, internationally as well too. And to the capital efficiency piece, I mean, this is so important. Today, even if you look at like lending, you can get an interest rate of like 10 to 15% annualized on a centralized counterparty, but you only have to post 20% collateral, where in DeFi, you can get 4 to 10% rates, but you post 120% of collateral. So very, very capital inefficient.
And I wanted to continue. Igneus, did you? Oh, sorry.
So personally, I really like DeFi, and I think what DeFi has to promise is something that we all want. But I think we also need to get a reality check. When you really you spend some time on Discord and Twitter, you really read through. DeFi is as it's currently set up, it's not at all what it's promised to be. So a lot of it is really hugely dependent on the team that is running it, and then you have 0x seafood situation, and then suddenly the price just everyone loses confidence in it, and then when Andre and his partners did 25 protocols, you just see all those price limp. The only DeFi protocol that is performing well lately, you can say it's just only Aave, because they just released their V3. Uniswap, Sushi, they used to be talked about blue chip, they are 60%, 70% down from their all-time high, and all the initial team have left. The MakerDAO initial project team have left. Uniswap left. Sushi, there's a lot of personality problem. And decentralization, you didn't think you need a hero, you need a team, but a lot of it is actually personality cult. That said, DeFi definitely points to a very clear direction long term, just so that when people's knowledge and when people's skill with crypto increase, they want to have they want self-custody, they want self-determination, and they want to be able to tap into those earning opportunities without giving away privacy, without giving away their tokens or the power. They want to have a say in governance. But with the whole narrative of DeFi 2.0 is just trying to reinvent that, instead of relying on mercenary liquidity that's attracted by a huge APY number. Sometimes we like to say, when the APY is too good to be true, it's because you are the APY. Just Olympus DAO just kind of popularized this DeFi 2.0, and they use this bounding mechanism to own their own liquidity, but it's still not performing well. So DeFi definitely has a lot of soul searching. You really need to lose the heroes so that you kind of have more people who are able to just kind of drive innovation and rely far less on VC funds, because a lot of DeFi tokens are still held by large VCs who have huge bags. I'm very optimistic about the long-term prospect of DeFi and really think it is the true destination that we all should be heading to. But in the short term, I think there's a lot of things that needs to be ironed out before we can truly see that potential.
Yeah. one fan in the audience. I wanted to ask you, I guess, what are the pain points that still need to be addressed for liquidity in crypto? What does this market currently lack, and what needs to be developed to allow for even more smooth trading?
I'm surprised we've made it through 30 minutes of a crypto panel and not mentioned the fact there's no prime brokers or credit intermediaries. It's astonishing. I very much struggle with this on any panel in current times to not address this elephant in the room. So I think Jakob's already mentioned when trading on exchange in crypto world, the norm is to be expected to pre-fund on the account, which from traditional markets is not something that's done. You're reliant on centralized credit intermediary such as a prime broker, and not have this pain point. So not having this does make it very capital inefficient because you're having to put your capital to work to move it around. And not all exchanges offer margin or credit lines against that. So I do think without having that in place, it's going to be a problem. And the biggest problem is that I think that the exchange infrastructure that we have at the moment, if you look at all these exchanges, they weren't built by necessarily people from traditional financial markets backgrounds. It's the known analogy is like with Mt. Gox. It was built initially as an exchange mechanism for a game playing card, Magic the Garden, playing cards, and a mechanism of exchanging. And the whole reason why you had to pre-fund is because you wanted to know that the person you were exchanging the playing card with actually owned it. That's where we've come from, right? So, and now we're saying, oh, no one's thought about the prime broker. And it's like almost akin, I think someone told me, to ripping out someone's vital organs if you to rebuild it. So it is a challenge. One of the great things about the crypto landscape is it's got this fantastic amalgamation between technology, finance, and a will to succeed. So, it will get addressed, and there are, some very innovative projects, and there are people putting their minds to work on this. But I think, it's very easy to say one of the biggest problems or pain points is this kind of capital inefficiency, whilst market making on the crypto exchanges.
And I guess kind of adding on to that, if we do address some of these inefficiencies in capital markets, if we do kind of get, maybe a lending market and kind of prime brokerages as a foundation, what would that mean for the expansion of liquidity?
I think it makes it much more accessible. I mean, if we, taking a step back from exchange trading, looking at OTC trading at the moment, in order to settle trades, it's all done bilaterally with a bit of an industry standardization that it's freer payment for the maker, and the poor taker has to settle DVP and pray that the counterparty they're facing is going to be there, and it eliminates that counterparty risk, that credit risk. If it then also has like a repo market in terms of settlement cycles, I think mentioned earlier, it's a 24/7 market. It never sleeps. So the only way to deal with that without a prime is literally bums on seats. It's higher headcount in lots of different geographical locations in order to make sure you have people to be able to create a 24/7 settlement cycle. To a degree, a prime with a flourishing repo market would solve that problem, I think.
And repo, we could spend a whole panel on why we need a repo market, but really one of the main reasons is, especially for centralized CeFi players like the ones on the stage today, when we need like a loan for balance sheet, or we're moving money around for settlement, sometimes you need that loan for, let's say, 2 days and 5 hours. It's not going to be a fixed 3-day loan, and you've seen DeFi really actually capture that need in the market, where centralized financial players really need that. And so having, accessible, deep liquidity on a repo market would just be enormously helpful. And then just in general standardization across structures around structured products, settlement times. And again, there's a lot of trust in the industry right now. The whole T+1 settlement operates on a basis of trust. But for example, there's no centralized credit scoring. Still today, a lot of centralized players won't necessarily talk to one another. If you know that one player, for example, you just won't onboard them, but you won't tell the other liquidity providers not to necessarily onboard them as well. So I think a lot of communication and standardization can still be done, but we've done a lot so far.
So for business idea for anyone new to the industry in the audience, repo market and credit scoring.
Can't wait for that panel. It will be cute.
Jakob, we've talked a little bit about some differences between the different market makers requiring pre-funding, and I've heard that settlement times can be different depending on who you're working with. And so I want to ask you, is there any standardization that needs to come in how different market makers within crypto operate, or is it something where even if each one has a little bit of a different kind of policy on how they operate, it still works okay?
Yeah, I think it's moving to a more sort of standardized setup, which usually has sort of embedded optionality within the contracts, and it does a few different things. Like it assumes that the market maker it should be aligned with the token issuer in the sense that what needs to happen for the market maker in order for them to be compensated is that the market, first and foremost, needs to have liquidity. So that's what they're hired for. 2 is that they will provide a positive cash flow to the token project themselves at prices which the token project, to a degree, can choose, which is above the current price. So you create a very aligned model that seems to be working, and you certainly don't want to create negative cash flow. You want to create positive cash flow. And the other part is when we talk about it's impossible to market make a completely new token without having that token. I need the inventory, otherwise there is no markets to be made. And the loan is important because you talk about what is the scale of the market making that you provide. I can say to someone, I want a huge option. I don't need any of your tokens to market make. I will not do any market making. That's what will happen. You're saying, what you want from your market makers, they should provide a significant amount of liquidity. And as a market maker, you assume that risk. So if you're putting $5 million on the bids and $5 million on the offer, your job is to manage that inventory across multiple exchanges, centralized and decentralized. And if you screw it up, the loss is on you, not the project. But so the loan in that case is very important. And I think that's very much a sort of a discussion. I don't say every single deal is the same, and it shouldn't be, because the token economics is different, the outlook, the roadmaps. And as a partner, if you're a market maker, you need to adapt to that as well. There's bad things with people saying, give me some money, and we share the profit. There's no market making in that. They're not going to be. There's no KPIs. There's nothing. I mean, you're supposed to be the buyer and seller of last resort, and the market making engine itself, it's optimizing for volume subject to 0 P&L. So it's providing a very sort of tight range of trading, and unless you have KPIs that you meet, you're not providing a service.
Yeah. I want to ask about specific assets. So, can open this up broadly for whoever wants to answer. I guess, how does crypto liquidity differ by the individual asset? Are there some, obviously Bitcoin is likely to be the most liquid, but I guess how do you wind up accounting for those discrepancies in liquidity in different assets?
In terms of the security or in terms of the products, like the instrument?
In terms of the instrument.
Yeah, I think the most highly traded instrument at the moment has been for some time is the perpetual swap. And I would say the reason why that is so highly traded is because on many exchanges it's levered the hell out of, and sometimes 100x and ridiculous levels. So for a very retail-driven market, and naturally it makes sense, right? And I shouldn't say it, but I guess an educated retail market who are looking to the upside, something that is going to give them the biggest bang for their buck is ultimately going to be more appealing. So a product like that naturally would lend itself as opposed to a completely unlevered, say like vanilla, just trading Bitcoin. So yeah, I mean that's without a shadow of a doubt the most liquid product at the moment. I think you agree.
Yeah, I mean I'd say that these markets are not very liquid. Crypto is not liquid. It's very active, but it's not very liquid. Something that is very liquid doesn't move around at 100% vol. So I think that we need to be careful about what we think is liquidity and what we confuse liquidity with activity. And that makes a market maker's role, buyer to seller of last resort, very important. I think it's very important to have a repo market so you can borrow. I think it's very important to build up a non-linear market so that you can tailor different risk exposures. And all of these are sort of hallmarks of healthy markets. And I think they're going to be, there's a question here, what in the future crypto trading happening on CEXes or DEXes, I think they will both exist. And I think they will be complementary to each other. And you will have options, perps, spot trading on decentralized and centralized exchanges. They will have different use cases. I certainly think that DEX will grow in absolute terms. I think that centralized exchanges will also grow in absolute terms. And over time, we should see volatility come down a little bit. And that should be a sign of liquidity improving.
Take the point of there's more activity than liquidity, but I don't think it is necessarily the fault of crypto itself. As a centralized exchange, what we see as the biggest bottleneck is never actually within crypto itself, and we there's always so much demand. Even anecdotally, we know actually the biggest bottleneck comes from the traditional banking industry. It's on-ramp, off-ramps are just so notoriously hard, and because essentially, it's not an inherent problem of crypto itself. There's always more demand. And the largest family offices, the largest fund managers are getting asked by their clients, can they have more crypto exposure? And many of the public traded companies or many of the public funds, they want that as well, but they have mandate, they have a board, and they have stakeholders to answer to. And those people, when there is lack of clear regulatory clarity, or when there's not a clear mandate from the investors, it's still hard. But the demand is definitely there once you have that very clear regulatory framework and that compliance level. More people who are currently on the fence, not necessarily because they are skeptical of crypto itself, but rather they don't know if they can do it in a way that makes them confident, will all come on board.
But we're about at time, but just real quick, I guess rapid fire. What are each of you watching in crypto liquidity? I guess what are you watching? What excites you?
For me, I would say the different ecosystems that are launching, whether it is and where they're launching. So development across layer 1s, layer 2s, where you're seeing different protocols building, and then how you're seeing that liquidity then move to centralized parties.
I think we're looking at the breadth of everything that's happening in the space. Everything from we talked a lot around the physical market, but one thing we haven't touched on is the structured products or the ETPs in this market. Which for us at Flow Traders is our bread and butter. And I think it's really exciting to see the new participants bringing new products to market, new exchanges, almost on a daily, not quite, but weekly, monthly, definitely basis. And I mentioned earlier this kind of great marriage between kind of technology and finance, and as an example on that, this subset growing in the market now that find they're not going to get comfortable with physical, so they're looking for the cash settled options. So there's a whole people looking at ISDA-based derivatives and how that can then grow and support the demand. So the problem's there, how can we solve it? So I think those are the things which we got our eyes on and really excited by.
Jakob?
So what was the question?
What are you excited about in crypto? What are you watching? What are you excited about in crypto liquidity?
So many things. What should I go with? I think we're doing quite a lot of work on the NFT side, actually, to see whether or not and sort of in-game assets. Just quite sort of funky skunks work, I'd call it. So one of many things.
Cool. I would call out two things, just thinking about liquidity more broadly speaking. One is regulatory frameworks and clarity, including for DeFi. We talked a little bit about that, so I'm not going into the weeds again. And the other one is like technology and innovation around interoperability. So we at Ripple, we have this vision of this internet of value. So like a world where money moves around, like information moves on the internet today. You can think of it almost like a layer on top of the internet. And just kind of like related to this question, you know, will the future of crypto trading be on centralized exchanges or decentralized exchanges? And if you think about the fundamental technology, you would want to lean towards, you know, this decentralized world, and just thinking about this vision we as a company have as well. You know, you would see a world where these networks, these value networks, are interconnected. Assets can freely flow around, and you see some of this happening with cross-chain bridges like multi-chain, all-chain recently integrated with the XRP ledger. And I think, yeah, it's pretty exciting to think about all the possibilities by connecting different value networks, and at the end, ending up in a situation where, you know, everything is tokenized. You can trade any asset against any asset, and there's going to be liquidity.
I love the answers, and I feel like I need to give a contrary answer because I feel like that already almost covered everything that I can think of. So I like to say, you know, crypto, like we like to talk about kind of like the technology and what kind of innovations there is, but I think we often undervalue the power of storytelling and narratives. When you look at kind of like some of the most influential kind of like crypto people on Twitter and like elsewhere, a lot of them, like huge VCs, they're allocating kind of like hundreds of millions and billions of dollars into certain tokens, and then they just, not to name any names, but there's a Singaporean billionaire who just like can't stop talking about a certain protocol like 3 times a week, and that moves market. Lots of times, like there is no shortage of money in crypto. The most scarce commodity in crypto is actually attention. How can you grab people's attention with your narrative? Like news media does that as well. Like, you know, sometimes we hear criticism that is targeted against crypto, and we don't think those are right. But like, what are the narratives that are getting played out? Who are the people who are talking about it? There's this kind of meme in crypto. People like to use the bell curve intelligence. You have the GigaChat, like Galaxy Brain. You have the DJ kind of like brain is like it caves in, and then you have the smart people in the middle, but they actually do the worst because they are kind of over-analyzing. Lots of times you really just kind of need to be that DJ who follows kind of like some of the biggest venture funds and see what they're allocating and just go with them. You actually do better than anyone else.
Cool. Thank you all so much. Really appreciate your time, and thank you all for coming out.